Welcome to this last session. It's one of the most important sessions because, investing in money. What is an idea without money? It's just an idea. So entrepreneurs need investments to roll out their idea, to go abroad, or just to pay the bill. So this is one of the most important sessions in my beliefs. But first, we're going to get an introduction from Michael Tresco, principal at Excel Partners, and you're going to give us an outlook on the developments of investment, right?
How do I? Is there a presentation?
You want a clicker? Let me see. Where is it? Oh.
There's the clicker. All right. Excellent. Hey guys, thanks for lasting through the day. Last one. I'd like to say it's going to be really fun, but it is going to be about fintech. So this is the time to leave if you were looking for something else. I'm actually going to focus not so much on the future. We can discuss that maybe during the panel, but just quickly click through a couple of trends that I think we've seen in a couple of last couple of years in fintech, and maybe give us a few talking points for the discussion. So on a global perspective, I think if you look at just the sheer funding amount and the rounds, you can clearly see this up into the right movement, which gets people excited and sort of, really made fintech a buzzword in 2014 plus. What's interesting is you see this clear jump from 13 to 14 in funding amounts, but if you look at the lower line of the VC funded deals, that's actually fairly linear. So a lot of the jump comes from the rounds becoming bigger, which is partially a function of follow-ons and partially a function of maturity of the industry, and B, non-VC investors entering the market. Then you see this phenomena of the larger rounds really zoomed in on this page, where you essentially see this number of 50+ million financing really increasing dramatically in 14-15, primarily in the US, to some extent in China, and then also increasingly in Europe. And then if you take a step back and say, well, what is fintech? And that's obviously one of the things that we're talking about. There's a number of industries here that are under attack from new companies. But when you boil it all down, most of it really happens around personal finance and SMEs, right? So if you look especially on the right side, the capital invested amount, about 3/4 of it goes towards companies that are addressing individuals and SMEs, and part of it has to do just sort of with the ease of acquiring customers, and part of it was the increasing preference of customers towards speed and personalization and mobile. And then when you look at the particular industries that are being funded within that, you can see on the right side that roughly, again, the same sort of 70-75% is really payments and lending, right? And lending in particular has been really getting a lot of attention and investment. And again, that's to some extent, that's the nature of maturity of the industry. So with payments, you've seen, PayPal pioneering that space in 2000, and with lending, you saw the emergence of Prosper or Lending Club in 2005. So these are, in this point, industries that are sort of 15 to 20 years old, and they have reached sufficient maturation. But it's also companies taking advantage of the opportunity that's been allowed by the incumbent banks in particular sectors, such as consumer lending and SME lending again. And that has created an opportunity to create really big companies. This is, again, sort of when you look at these unicorns and look at what sectors they're in, most of them are in lending and payments, and there's a few in insurance, but that's kind of it. And for Europe, if you look at the same chart here, so you see the same movement in 14 and 15, and roughly 10% of global fintech activity, and also 10% of the activity within Europe is fintech. So not a huge amount, but certainly growing. And then what's interesting, when you look at geographic concentration, a lot of it is around the UK and Germany, which are the larger markets, but clearly overrepresented here relative to GDP in Europe. and again, to some extent, a function of maturity of these markets and regulatory environments. But interesting one to think about. And then last but not least, if you look at some of the bigger companies in Europe in this space, again, if you look at Creditech, IZETL, Ebori, World Remit, Funding Circle, most of them are again within the lending and payment spaces. And then you have guys like Adam and Raisin that are focusing more broadly on consumer, but still we see the same trend holding true for Europe as globally. And I think that's it. That's all I have.
Well,
thank you.
Thanks a lot for this introduction, Michael. You now become a panel member.
All right.
That's you have two roles. Michael, you're a fintech guy at venture capital firm Excel Partners, and you just closed a fund. You raised a fund of $2 billion, right?
500 million for European opportunities, 2 billion in total globally. Yeah.
And how many of that portion is focused on fintech?
No clear allocation, but it's certainly an area of interest for us. So we're investors in a number of companies like Funding Circle, World Remit, GoCardless. So I think going forward, we'll continue to do a lot in the space.
You have a soft spot for people who call other people dude. So I will call you fintech dude.
Works for me.
Okay then. How many people are here investors? Yes, and who are entrepreneurs? Okay, that's half from half. That's quite nice. Well, welcome to the second panel member. We go to Stefan Klestil. Hi, Stefan. You are a partner at Speed Invest, and you have a venture capital fund of 90 million euro with a full focus on fintech, right?
No, a little bit like Excel. We do all digital tech, and we're trying to stay anywhere between 20-30% of the fund for fintech, but at the end we're entrepreneurs, and so we move with the opportunity, let's say. Yeah. Probably at this point we're a little bit ahead of that.
And you have some portfolio companies like Payworks, Vinest, and Wikifolio. These are fintech companies, right?
Sure. I would add Curve, FinanceFox, Loot. Wikifolio is running around here. They're here today. I'm in the advisory board of number 26. So yeah, it's getting. And
I saw on your LinkedIn you started just like Michael Lewis as a summer intern at Salomon Brothers.
Okay, it's a long time ago, very long time ago. You know what? It was a good experience. I learned that I didn't want to become a spreadsheet monkey, for sure. But it was actually really helpful on the resume. It was very helpful to get into A.T. Kearney and then payments and so forth. So, yeah.
Yeah, smarter than I. It took me 2 years to realize that it took you only a summer.
Okay.
That's good.
Well, thank you for being here.
Sure.
Now we go to Vladislav Solodkiy, one of the top 35 most influenced fintech persons in the world. So thank you for being here. And you're the CEO at Russian Venture Capital Fund Life.SREDA.
Right now in Singapore and already for a year.
You are now in Singapore, okay. And you have a fund of $100 million.
Yeah, now we manage two funds. Already we just launched third fund focusing on blockchain. First fund was $40 million focusing on US and Europe. We invested in such companies like Simple Bank, Moving Bank, Feeder, SumUp, Anthemius Group in UK. It was fund-to-fund deal. We already made 6 exits between these first 13 companies, and 2 years ago we saw such great growth in Asian region, and we tried to do some remote investments in Asia, but it's impossible. You have to be there face to face. You have to meet with people, describe what they're trying to do, about your personal values, corporate values, about your vision, and finally 1 year ago we relocated ourselves to Singapore and launched second fund focusing on Southeast Asia and India.
You had a very successful exit. It was simple.
We already, as I mentioned, made 6 exits. We exited from Simple Bank. We several other companies.
But you sold it to BBVA for $117 million.
Yeah, with whole other great investors. It was a great deal for everybody.
So, Michael, why do fintech companies raise money? Where do they use it for? Is it for the IT? Is it for the electricity bill? Why do they need it in general?
Oh, interesting. Well, I think for the most part, it's just like any other startup, it's the same reasons as you said. It's R&D, it's sales and marketing. I think the one thing I would add probably is regulatory expenses that in some cases can add up, especially if you want to get a banking license that can become a little bit more expensive and you need regulatory capital. But other than that, I think it's the same growth capital.
Do these fintech companies in general make profits already? Because when the dot-com bubble, there were a lot of high values, but they didn't make a lot of profits.
So we think about it on a unit economics basis. So if the unit is a customer, what we are trying to understand is to what extent a company is profitable when interacting with an individual customer, right? And then it doesn't have to be profitable as a whole, because if the company is investing a lot in growth and trying to grow quickly, that means that a lot of time the marketing expense is going to outweigh the profits. But as long as they are profitable on a customer level, we see that as a good sign.
Vladislav, was the company you sold called Simple, was it making money already? Profits?
Really, you are right. Profitability is the issue for fintech companies. It sounds funny, but it's an issue. But in terms of our 6 exits, none of these buyers bought these companies for profitability. All these bigger companies, and also we participated as due deal advisors, for example, in such acquisitions like LoopPay for Samsung. Samsung also bought not revenue stream from LoopPay. Most of these buyers or strategic investors, what they try to buy, they invest in attention, how fast you can attract attention of customers, because right now so much noise around each person, and only few of companies can attract attention and create loyal customer base. Second one, marketing acquisition. For example, Simple Bank highlighted 10 times cheaper customer acquisition in comparison with traditional banks in UK or in US. Also, they buy new technologies for them and new mindset, because so many banks right now try to set up some internal teams inside this bank to organize some hackathons or innovation labs, etc. But in 90% of these cases, it's they are failing, because when they're inside, it's impossible to change all this big body. But if you create something standalone or independent, for them to grow faster in new areas via M&A, it is finally cheaper and more stable, and you can predict your success better than in terms of to hire some new employees, to set up some 2-3 hackathons and innovation lab. It provides PR, but it do not provide new unicorns or something like that.
And Stefan, is there enough money for fintech startups at the moment in the market?
I mean, there is no lack of capital that I can see. So, really, I mean, we are talking about a lot of different things here. So because all of us, I think, we invest into young consumer brands, ultimately in fintech, which of course has requires a very different type of funding strategy, and a lot of funding at the end of the day. There are B2B plays that do not require that much funding, which can turn profitable very quickly. There are lending plays, especially, for instance, invoice financing or SME financing, that can turn profitable very, very quickly. So it really depends what we're looking at. I mean, we try to, obviously we all love to invest into real disrupting startups. And what does disruption mean? It's always the same thing, significantly lower customer acquisition cost, significantly higher cross-sell ratio through frictionless mobile, and at the end of the day, radically lower unit cost. You put those together, and that will really, really change the market over many, many years. It's going to take a long time. And so we get involved at the start, but that of course doesn't mean it's only going to stay VC financed. There's all kinds of different ways of funding towards an IPO or towards a trade sale. So, and you, guess what? When we get involved really early, we typically come in earlier than those guys, really in the seed round. You simply don't know yet, 2 years down the line, if this is going to be the opportunity we're hoping for, if the team turns out to have the qualities and the leadership to actually go to that level. You don't know. I mean, you take a bet ultimately, and so things happen sometimes. So.
But there are some fintech companies in this room. Have you already raised some money, and how did it go? Can somebody give a comment on that? Yeah, did you? You are from?
I'm from IO Digital. We're a blockchain developer.
You didn't raise money yet?
No, we are privately funded by ourselves. So we invested in our own company because we believe what we do. And we are basically in the early stages of being a real company. So we're looking for collaboration, not only the money, but more like a collaboration with investors, the ideas that they have, the market they foresee. So it's not only money, it's also knowledge.
Is that an argument you hear more often, that startups don't want your money but your knowledge?
Well, I think the sequence is correct. So first you want the money, but ideally you want more than that, right? And I think if you're in a situation where you have attracted interest from more than one party, you certainly should try to ask yourself, how do I get along with the person who is going to be working with me? And two, what is the value at beyond capital, which at that point becomes the unifying premise. I fully agree with that.
Yeah, this is getting more and more important. The good founders, the top founders, they can pick and choose, and so they really want that extra value and that attention. Calling us on the mobile phone and really, challenging us on many fronts. That's a good founder. We love those people, but they're intense and they require our time, and so.
How do you seduce these popular founders and fintech companies to go to your fund?
Say it again, sorry?
How do you seduce these fintech companies who are very popular to?
Yeah, you build a reputation like everywhere else. There's a lot of word of mouth in the industry. I basically give them 5 names and phone numbers of other founders. Typically, they've already done that due diligence anyway, right? I mean, the good ones, they know each other, they talk to each other, they meet at conferences. And that's always the best way to, get recommended, I guess. Yeah.
I saw that in SME and payments there were the most investments. Is that also where there are the highest profit margins?
Oh, that's interesting. I guess you would argue if there were the most investments, that's where there are most companies, so that's where the lowest profit margins would be. I think it more has to do with the size of the opportunity and the level of differentiation versus incumbents than necessarily profitability, which you would expect to go over time as competition increases.
If you look at MPS acquiring, online remittances, it's very low margin services, but these services provide great opportunity to know more about your customers. And if you, for example, check trend of MPS acquiring companies like Square, SumUp, iZetto, etc., finally their monetization strategy belongs not for their core product, to accept payments, but they started to provide SME loans, they started to provide POS management system, and finally to increase the margin. From second part, we see such directions like online lending, SME lending, the extremely high margin companies, but they participate on overcrowded market, and their CPA, customer acquisition of customers, became more and more expensive. And right now we see very interesting scenario when 2, 3, 4, 5 companies started to not only partner together, but also they try to combine something like FinTech Bank or FinTech ecosystem. We saw partnership between Number 26 and TransferWise. We saw partnership between Feeder Bank and SumUp. We saw partnership between Movin and Common Bond. Movin attracting customers very fast and very cheap. common bond provide very high margin product. It's great opportunity to combine advantages of different streams, because really in we see in fintech about 24 directions, but in terms of profitability, only 7 between them really can provide cash flows. But most of them, they're focusing not on immediate cash, they're focusing how to attract customers very fast and very cheap, how to know more about these customers and to predict the risk ratios, their future upsell, cross-sell opportunities, and how fast they can cover new markets to expand. And 7 directions can provide.
And how can you guys compete with, as investors, with banks who have millions and billions of dollars on their balance sheet?
As investors or the companies that we invest in?
For these companies.
Oh, yeah, well, I think we're hoping to not compete, but partner with banks. I mean, I think we all ideally have complementary value adds, I would say. So I think it's typically, I think, Stefan, you talked about this earlier, when you were just starting a company, probably would be great to work with someone like you who's done it many times before. And then when it comes to really trying to get channel partnership advantages, I think financial institutions can be really valuable. And so I think we don't really see ourselves as competing against banks, but just hopefully providing complementary value proposition sets.
Yeah, a colleague of ours from Santander in Ventures last week at Money, he said, "Oh, this is so 2015." I liked it, sort of pitting banks against fintechs. At the end of the day, there is practically no investment we make where the fintech, the startup, doesn't have a relationship with a regulated institution, because you need it. It's a regulated industry. So, so there are banks who are cooperating and making a lot of money by cooperating with fintechs. It's a great way to make money, and there's others that are in sectors where we are not even touching it yet. So I personally am enormously interested to cooperate more with bank VCs or banks on really big topics that we haven't even touched upon. So I've said this many times on blockchain. I mean, we would not dare at this point to do a seed investment as the only institutional investor into a blockchain company unless there's a very clear use case, and we would probably feel more comfortable partnering with a bank on a specific use case. Let's say trade finance, for instance, revolutionizing trade finance using the blockchain. Yes, of course, the banks could form a consortium and try to solve it. We all know that that's very unlikely that these approaches will work. So maybe we can partner with them and maybe help them validate some of what they are doing. So I'm very interested in those topics as well, because most of it is going retail payments on the front end, and now insurance is being added, which we are all, I think, very excited about, because that number is still really slow, and that number will grow for sure. But I think there's so many other topics where we would love to work more together with banks, also as co-investors as well.
If we will analyze deals for last year, between these 2 billion investments in fintech area, only 28% belongs for investments from banks or corporate funds of these banks. Less than third party of this amount, and typically banks are not able to lead or to facilitate deals. If we will check all these deals from banking side, it belongs for co-investments or following of the deal, of these deals. Not they are not leaders of this movement, but I agree that right now for banks it's very interesting tipping point how to partner with currently existing VC fund with expertise, with knowledge how to structure deals, how to provide post-deal support to launch their own practice or to invest in some funds which are able to invest after that directly to fintech companies, because to have money it's not enough. I mean, you have to scout companies, you have to find the best, you have to analyze them, you have to understand for whom you will sell or how to partner with other companies. You have to spend time for this, and you have to hire people. And typically, who will be inside these banks will lead this practice.
And you all, the three of you, all trying to find the next Uber of fintech. How can you recognize one? Is there a next Uber of fintech in the room here?
Several, right?
You are, yeah. First, you say how can you recognize the next Uber of fintech, and then we're going to check it with someone in the audience.
I am pretty sure I can't, but if
you don't have a checklist?
But if somebody's very confident that they're the next Uber of anything, I'd love to talk to you guys.
But Michael, you have a checklist, of course, like there's this, and this, or not?
No, it's not really a checklist. I think we start by saying we'd love to work with entrepreneurs that are ambitious and are going after big opportunities, and ideally have the right skill set to pursue those opportunities. And I think that's the beginning of the conversation, and then it becomes fairly subjective. So.
And Stefan, is it the idea of the fintech company or the entrepreneur behind it? What's more important?
No, it's the entrepreneur for sure. I mean, obviously you want to be in a market that provides opportunity for disruption and profit, of course. But great entrepreneurs have a good nose for identifying exactly those and then focusing on them. So when we get involved, the quality of the founders is the key thing. By far. But again, I mean, now that we're moving maybe in more sort of hardcore banking topics or insurance topics, I think some of that won't be enough. We need to complement that with sector skill, deep sector skill, pretty soon in the course of the development. Otherwise, you will always stay a little bit on what it is now, very much on the front end, on the UX, where the banks are easily being beaten, on the design, on the convenience, mobile convenience. But I think we need to move beyond that. So maybe we need to create new types of teams going forward from obviously the classic founder types, but marry them with sector experts to shorten the learning curve also. Yeah.
The last topic, because we ran out of time. We saw your graphics, and the investment was going higher and higher and higher. Is there any chance we are creating a bubble like with the .com has happened?
For sure, absolutely. There's always a chance, yeah.
and is it already in the making?
But you raised your funds, so you're okay.
Yeah, we have nothing to do with the bubble. It's all the other guys, right? So I think the question to me is always, you have to really look in the individual investments and understand the criteria and sort of the valuations, right? And then if on an individual investment level you feel like the thesis and valuation are appropriate, then it all seems to make sense, and then the growth can be just a factor of just underlying trends and people recognizing the opportunity in the market. If you see some irrationality in how people are valuing the opportunities, then that can become an issue, right? But I think it's really tough to look at that just on an abstract basis. You really have to look in individual examples and do it that way.
How are the valuations in general?
We have a different environment now than we had a year ago, for sure. But I would say, I would sort of defend more the European-based funds. I don't think we've ever stopped asking the right questions, meaning, so how are you going to make money? What's your business model? Not just looking at user revenue growth, which unfortunately I've seen a lot happening in the US. So in the US, I think the pendulum has swung back for sure. So they're again asking the more basic questions, but I feel we have never stopped doing that, and we shouldn't stop doing that. But the U.S. funds are really important, and so at the end of the day, it means that the founders will have to be much better prepared. They will have to be much more convincing on their business model and on their financial model, and that's a good thing. And there will be a couple of startups that won't make it. Yeah.
So no bubble creation in your funds. Last question for Vladislav. What's going to be your next exit?
Can I link this question with previous question? Because I want to add that I'm not agree that we can see the bubble inside FinTech, because if we will organize structure of exits between FinTech and other areas, for example, e-commerce or other streams in VC area, we will see that most of exits belongs to M&A. I mean, these companies, there are only few of them focusing on IPO and really so inspired to create more and more unicorns and finally to attract money via stock exchange from retail clients. But if we will talk with most of FinTech entrepreneurs, they really will be happy to sell their companies for several $100 million, that's all, not to be unicorn, not to be listed on NASDAQ or something like that. And I think that it's very organic growth, and for banks often cheaper, as I mentioned before, to buy these companies. In terms of our own fund, we invest in 13 companies in US and Europe, as I mentioned, and we launched second fund focusing on Asia and already invested in 6. And one of these company in 1 or 2 months will be listed on Australian Stock Exchange. It will be next exit, seventh exit for our fund and first for second fund.
Okay, well, thank you for your time, and I'm wondering who's going to get the next Uber in FinTech from you three guys. And give them an applause, and many thanks.